The 2024 federal budget was just announced, and one of the items discussed within it pertains to capital gains taxes. And more specifically, they were looking to increase the capital gains tax rate from where it currently is today. So this can have an impact whether you personally own assets, whether you are a business owner and have assets within your corporation or your holding companies, and if you have a trust as well with assets within it, it can affect all three scenarios. In this video, I'm going to break down the potential impact it can have if you are a business owner and have assets within your corporation or holding companies, and those assets are potentially facing capital gains taxes. I'm going to show you really the difference of the, call it, old system compared to the potential new system. So let's say you have your corporation and you have a rental property within it. Now, I'll call this the old system, which is basically before they just announced the 2024 federal budget, which can potentially come into effect June 25th, 2024. So let's say this individual purchased this property for $1 million and they sold it for $2 million. Now, for simplicity, I'm going to exclude betterments and improvements. So the total capital gain is $1 million. Now, how the tax system works, call it in the old system, is 50% of that becomes taxable to their income, which is $500,000. And the other 50% will credit their CDA, their capital dividend account. And this is a very important thing to take note of. So this red line represents the credit this business owner just received for their capital dividend account because of the sale of this property. And this means there's a $500,000 credit to their capital dividend account, which means they can pay $500,000 of tax-free capital dividends out of the corporation. So capital dividends are commonly misunderstood and really people don't even really know about them. But I wanted to show you, this is directly off the CRA website. So word for word. So capital dividend account, CDA, certain dividends called capital dividends may be paid tax-free by private corporations to their Canadian resident shareholders. This means that no part of the dividend is included in computing the shareholder's income. And again, this is directly word for word from the CRA website. And the most common tax-free amounts included in the corporation's CDA are, number one, the tax-free portion of capital gains realized by the corporation to the extent they exceed the non-deductible portion of the corporation's capital losses. I'm going to explain what that means on the next slide. Number two, life insurance proceeds on certain policies. And number three, capital dividends received from other corporations. So to point one, by definition, if the CRA hasn't changed the definition of how a business owner can get a credit to their capital dividend account, under the new system, which is the new proposed increase in capital gains taxes, they're now proposing that corporations pay 66% tax instead of 50%. So on that same $1 million capital gain, what is taxable to their income is now going to be $660,000. It's 2/3, but I'll just use 66% for simplicity. However, the difference, the non-taxable portion, is now only 1/3. I'll call it 33% just to round. So the credit to the CDA is now only $330,000, not $500,000. So same thing, red line represents the credit to the CDA. This individual now only has a $330,000 credit to their capital dividend account, which means only $330,000 of tax-free capital dividends can be paid out of the corporation. So in other words, that's $170,000 less of tax-free money, because in the previous example, they were eligible to have a $500,000 tax-free capital dividend. So if all else is equal, it seems that not only will business owners pay more in tax, but the credit they receive to their CDA seems like it's going to decrease. This also works for assets like having a stock portfolio or investment. So it doesn't just have to be real estate. So again, say you had a stock portfolio under the old system, let's say you had initial investment of $1 million, it's now worth $2 million. You sold the stock for $2 million, total capital gain of $1 million. 50% becomes taxable to your income, and the other 50% credits the CDA. So red line represents the CDA credit, $500,000 credit to your capital dividend account, which means $500,000 of tax-free capital dividends can be paid out. That's the old system. With the new system, it's going to be the same thing where 66% is going to become taxable. The other 1/3 is going to credit the CDA. So now the CDA credit is only $330,000, not $500,000, which means only $330,000 of tax-free capital dividends can be paid out of the corp tax-free. Again, it's $170,000 less in tax-free money. Because of this potential increase in taxes, you want to look at other assets the corporation can own that aren't going to necessarily trigger higher tax rates for yourself. And one of those assets is going to be a whole life insurance policy. So whole life insurance comes with the life insurance, the death benefit, but it also comes with the savings account, the cash value it's called. And the cash value is something that you should be using during your lifetime. So this isn't a product where you have to die for anyone to benefit. This is something as a business owner you should be using during your lifetime. And you can leverage and borrow against the cash value on a tax-free basis, and you can use it for things like business investments, business emergencies, business cash flow, really any sort of business need. And you can also use the cash value to obtain a tax-free personal line of credit. I'm going to walk you through both examples of how you can use that cash value. But one thing to take note of is when you're using the cash value and you're borrowing against it, you're not triggering capital gains. And if you're not triggering capital gains, you're not triggering that additional, or now the potential 66% tax bill that is associated with it. So let's say this individual over a course of 5, 10, 15, 20 years has invested $1 million into this whole life insurance policy, and the cash value is now worth $2 million. What they're going to do is they will loan against the $2 million in the cash value, and they're eligible to receive up to $2 million tax-free. Now, they can use the insurance company to do a policy loan. They can go to a third party to do a collateral loan against the whole life policy. In this video, I'm not going to go into too much detail, but just note that when you use cash value as collateral, so it's like putting a mortgage on a house, you're not triggering any capital gains. What you're doing is just using it as an asset to borrow against, and in return receiving a tax-free amount of money. Again, depending on whether you do a policy loan or go to a third party for a collateral loan, the amount you're eligible to receive tax-free will differ. But nonetheless, let's make that cash value turn to $2 million as an example. You could have $200,000, you could have $10 million in the cash value. This individual can now leverage this $2 million for tax-free money. And again, they can use that for the business investment, business emergency, business cash flow. And they can also leverage that $2 million for a potential $2 million tax-free personal line of credit. So again, you're not selling the cash value like you are selling the property or selling the stock portfolio. That $2 million is continuing to grow year over year. You're still receiving dividends from the insurance company, assuming they're paying dividends. It is tax sheltered, so it grows free of annual accrual taxation, which means you're not hit with a tax bill every single year. And you can leverage it for business or personal use. On the personal side, there's a lot more to go through for this personal strategy, but there's guarantee fees, there's underwriting. Obviously, always speak to an accountant and a lawyer for any strategy at that matter. But just note that one of the ways to plan for this potential additional tax rate is going to be the use of additional and alternative assets, and that being a whole life insurance policy. Now, on the back end, as a business owner, if you were to pass away with a whole life insurance policy, you also can help credit the CDA. So let's say an individual had a $10 million life insurance policy and they passed away. So $10 million will be paid tax-free to the corporation because the corporation is the owner and the beneficiary. But the corporation will also receive a credit to the CDA. Now, depending on the type of life insurance they own and the age the individual passed away, let's just assume this individual lived to life expectancy, so the CDA credit was equal to the life insurance death benefit, which is $10 million. Sometimes it could be less. But for this example, we'll assume it's the same. This means $10 million can come out of the corporation tax-free. So if the business owner's family needed the entire $10 million out of the corporation, they could just pay that as a capital dividend. It comes out tax-free. So you've just really had a corporation pay for a policy, and then we're able to take out the money completely tax-free for family or whoever the beneficiaries are going, or whoever's going to use the money essentially after it flows out of the CDA. But the other planning opportunity with this is some families don't need the entire amount out of the corporation tax-free. They might need a few million, but they can also retain some of that life insurance payout in the corporation. And you may have other family members, other shareholders, and future generations who are going to be part of this corporation or holdco. So you may be able to keep some of that money in the corporation and pay an income to these people for a very, very long time. But you may be able to take out additional profits through the CDA credit as well. So what comes out of the CDA doesn't have to actually be the life insurance proceeds. It's the life insurance policy that creates the CDA credit. and now your beneficiaries or family members have the option as to what they really want to take out of the corporation on a tax-free basis. So as a business owner, it certainly gives you options from a estate planning perspective and a tax optimization perspective of really deciding on, okay, what's going to come out of the corporation tax-free, because if you don't do the insurance, you're not going to have a credit and everything's going to essentially be taxable, fully taxable coming out of the corporation. Now, to take it one step further, if you had that $10 million life insurance policy, and let's say as a business owner, during your lifetime, you were borrowing against your policy as much as you basically possibly could. So you borrow, let's say, $6 million over the course of your lifetime, and maybe this includes interest as well. So when you pass away, the insurance company will deduct whatever has been borrowed against the life insurance payout, the $10 million. So $4 million will get paid tax-free to the corporation. However, the CDA credit doesn't factor in the net payout. It factors in the total death benefit. So the credit, assuming this individual, again, lives to life expectancy, will still be $10 million. So what that means is the corporation is eligible to take out $10 million worth of assets through the CDA as a tax-free capital dividend. So the $4 million will come out tax-free, plus there's an additional $6 million of room. Now, this owner may have had $6 million of profits sitting in the corporation. So if they did, they could take that out completely tax-free, that $6 million of profits, and just for simplicity, assuming a 50% tax bracket, that would save them $3 million in taxes. So this is another strategy where, as a business owner, you're saving money into a whole life insurance policy. It's growing free of annual accrual taxation. You're borrowing against it on a tax-free basis during your lifetime to use for business or personal use. And then on the back end, when you pass away, it's going to help you get assets out of your corporation tax-free to your family and other beneficiaries. So with these new potential rules, there are planning strategies to help kind of guide around it. And I just wanted to show you and give you some ideas as to how, if you are a business owner and facing capital gains taxes, this is a potential solution to that.